Hey everyone, happy Thursday, December 12th. It's a little after 11:30 on the West Coast, and it's time for another market update. Next week is the big Fed meeting. It's when they'll make their next announcement on whether they're going to keep rates where they're at, they're going to cut, they're going to hike, which they aren't going to do, thankfully. But this week, we got two big points of data that gives a little more clarity on what the Fed's going to do. So the first thing we got going back to last Friday is the big November BLS jobs report. This is a big one every month. It's killed us. A couple months ago, September, it ruined any of the rally we had going there for a little bit. And this number came in a little bit higher than expected on the headline, but there was a lot of underlying weakness that the markets like. So let's take a closer look. So keep in mind that the BLS jobs report has two different components. They have the business establishment survey, where they take some data that they have and use seasonal adjustments and mathematical formulas to spit out the numbers. And then they do a household survey where they actually call people. So this is the business establishment survey. Seasonally adjusted, it showed 227,000 jobs were created. The estimate was 214,000, so higher, which is not generally good for us. And then they added back to the last 2 months for October and September, they added 56,000 jobs. So again, not necessarily positive for us to see those higher. But the October number was so low at 12,000. It went up quite a bit to 36,000, but I think less than the markets expected. They saw that low number and think maybe this is going to be adjusted over 100,000. So, adjusted higher, but not as bad as it could have been. And then another thing to take a look at in this, the birth death model, where they try to, estimate how many jobs were created and how many jobs were lost based on businesses opening and closing, was up 5,000, where the ADP number was minus 17,000 seasonally adjusted. So slightly different numbers there, but, at least in the ballpark. And then the government healthcare made up 87,000 of these jobs. And government healthcare aren't really affected by the fluctuations in our economy and stuff. We're always adding government and healthcare jobs. So that's something to discount a little bit. Next part, like I said, we get this the household survey where we actually call people. That is where we get the unemployment rate from. That jumped from 4.1% to 4.2. This report, instead of 227,000 jobs created, it shows 355,000 jobs lost, and then shows the total labor force dropping by 193,000. Keep in mind with this total labor force number, the way they do this is when they call people and they ask you, hey, did you apply for a job this week? Or did you interview? All that kind of stuff. If you said no, just because you didn't see a job you could apply for, you're looking online, how we all do it these days, they would take you out of that number. They would take you out of the labor force. And since they get this unemployment number based on the number of total people unemployed in our total labor force, by taking those people out of the labor force, kind of keeps the unemployment number lower than it actually is. So, for this month, for instance, 4.246 was our reported number, just below where they would round up to 4.3. But if you add those 193,000 people back to the labor force, that number jumps to 4.355, so almost 4.4. So, just because you didn't apply for a job that week doesn't mean you're not still unemployed. So it's a little wonky how they do, how they look at those numbers. So just keep that in mind. Next thing. So the household survey, there was 355,000 jobs lost, but breaking up by age is very interesting because basically every age group except for 16 to 19-year-olds and other, which I'm assuming is 15 and younger, had job losses, big job losses. So, seasonally they're hiring kids to work these holiday jobs, but everybody else, their jobs weren't being created, especially 25 to 54. This is the big, that's our big labor age. This is where most of our workers come from. And that was down 204,000 jobs. So definitely some underlying weakness there. And then unemployment's lasting longer. Going back to November of last year, the average amount of time people were on unemployment was 19.5 weeks. That's jumped now to almost 23.7 weeks. So what is that, coming up on 6 months? So again, that is some underlying weakness. Doesn't paint a rosy picture of our economy if people are having to stay on unemployment longer and longer and longer. And one other negative thing from this job, or positive for us, I guess, full-time workers dropped by 111,000 and part-time workers dropped by 268,000. Again, a lot of job loss compared to job creation. So, 111,000 jobs, full-time jobs loss is not a positive thing. Shows quite a bit of underlying weakness in our labor market. One positive or headwind we dealt with in this report was average earnings. So average hourly earnings, hours worked, and average weekly earnings all went up month over month. This is something we tend not to like just because it's inflationary. The more money we all have, the more money we're making, the more money we spend. The Fed starts worrying we're going to make inflation go back up again. So that was, but besides that, overall, pretty positive reports. The markets really reacted pretty well to it. We had a nice little rally on Friday after that came out. So good to see there. And one of the data points we needed to see before we were confident what the Fed would do next Wednesday. The second thing would be in the November CPI. So this isn't the Fed's favorite inflation report, which is PCE, but CPI is important. And as it came in as estimated, about what we expected, but the shelter numbers, which we'll look at, are still way too high. So as I said, headline and core were both up 0.3% month over month. Year over year, the headline's at 2.7, the core's at 3.3. And the core is what the Fed really pays attention to. It takes out food and energy costs, so they feel they have more control over that. And as you can see in the CPI, shelter makes up 45.8% of that core number. For the month, it made up 0.16 of that 0.31 increase. And for the year of that 3.3 year over year number, 2.19 all comes from shelter. And the three different things they look at are rent, owner's equivalent rent, which is current homeowners saying how much they rent their house for, which is a little weird, and then lodging away from home, which is hotels, Airbnb, and all that kind of stuff. So rent and owner's equivalent rent came in pretty good. Lodging away jumped quite a bit, and this is a volatile number. Sometimes it helps us, sometimes it hurt us. Definitely hurt us. It went up 3.16% month over month. Food was up about 0.4%. Used cars were up almost 2%. Motor vehicle insurance was up a little bit, but down. It's starting to come down year over year. It's been so high all year long. And then everything else core was just year over year number just made up 0.2% and a 0.005 monthly effect. So, like I said, overall, not the worst report. Definitely wasn't something, if it came in really hot, maybe the Fed changes their mind. But also on the flip side, it wasn't something that came in so slow and we get a lot of, big rally off of it. But it did check that box because it wasn't a negative surprise. So that was good to see. Today we got November PPI, which is producer inflation. It was up 0.4% month over month, 3% year over year. That core number was up 0.2 month over month, 3.4% year over year. This 0.4 number, it's funny. Chicken egg prices went up 52% last month, and fruit and vegetables went up like 30 something. Those two just by themselves made up half this number. But without you take those out, it was up 0.2%. So, higher than we liked. We didn't, the markets didn't really like this, but it looks like a lot of it had to do with chicken eggs and fruits and vegetables, which is interesting. Initial jobless claims. This has been really low, and this actually saved us a little bit today. This came in higher than expected. It was supposed to be about 220,000, came in at 242,000 new unemployment claims. Like I said, it's been low for so long. Maybe this is a sign that these numbers are going to start going up and showing, the weakness in our labor market, or maybe we'll drop back down to 220 next week like it's been for so long. So have to keep an eye on that, but at least for today, it was a positive for us to see that jump up. Where does that leave us? The average 30-year conventional is at 6.82. Last week, 6.84. Dropped down a little bit and then came back up over the last couple of days. So about where we were last week, higher than we want, but not a 7 at least. Where does that leave us? Upcoming next Wednesday, we get that Fed meeting. The Fed right now, for a while there was, I think, 55-45. They would do a quarter point cut or not do anything. Then it jumped to 70-30. After this week, after that jobs report, after that inflation report, it's at 98% chance they'll cut by a quarter point and 2% chance they'll do nothing. So good. That's what we wanted. So it doesn't look like there'll be a surprise pause at this next meeting. But on the negative side, now the markets are thinking instead of 4 quarter point cuts in 2025, just 3. So looks like maybe the markets are thinking they're not going to cut their rate as much in the upcoming year as we hope for. But overall, not the worst week. If anybody needs anything at all, please don't hesitate to reach out. Otherwise, have a great week. Thanks, guys.